I'm speaking with Jake Elmhirst, partner and head of private wealth secondaries at Coller Capital. Jake, first of all, it's a great pleasure to have you here from the United Kingdom at the Inside Network's Alternatives Symposium.
James, it's always a pleasure to talk to you.
You too. Now, you'd have heard this so many times, Jake, that for private wealth, the challenge with private equity has been liquidity. Coller has been leading the way with secondaries for decades, and that space has very good inherent liquidity. So why do you think advisors should be looking at that as an opportunity, or did I just answer that question the way I put it?
Well, I think you answered part of it, but actually secondaries give you a couple of other things that really investors should be thinking about. In one go, you can achieve broad diversification of your portfolio because we're buying into sometimes 5, 10, 15, 20 different underlying funds, each of which may have 10 or 20 assets themselves. So you can build a lot of diversification using secondaries. Secondly, the cash comes back quickly because you're buying part of the way through those funds' lives. So to your liquidity point, you get your money back fast. But thirdly, you're almost always buying at a discount to NAV. So your risk of loss is significantly reduced as well. So those features mean the risk return is particularly attractive on an absolute and relative basis compared with other areas of private markets.
How should advisors communicate the advantages of having both private equity and private credit in their portfolios?
Well, if you think about liquid assets, you wouldn't build a liquid asset portfolio that was 100% equities. And I think it's right to think about private markets in the same way. You know, you can't really build a properly diversified portfolio just using public equities anymore because the markets become increasingly narrow. So you need to have private markets. 90% of companies with revenues of more than 100 million are private. So it makes sense, if that's the case, and you need private markets for diversification, that within private markets, you also diversify across equity and credit.
Where do secondaries sit within a portfolio and at what kind of level of allocation? And how should advisors be educating clients about alternatives in the first place and then secondaries beyond that?
Well, for any client that's thinking about investing into private markets, the first question you have to answer is how much illiquidity can they tolerate? But once the client has accepted that they are investing into something illiquid, really, if you took an institutional approach, then probably your allocation overall should be somewhere around the 20% level to private markets. And within that, secondaries could be the sole holding because it's so diversified. I mean, it should certainly, in my view, be a core holding around which you can build other satellite exposures.
Are there any particular examples that advisors could share with their clients to help capture and demonstrate the diversification benefits that secondaries bring?
Well, I'll give you an example of one investment that we've made recently, and it's one investment in a portfolio where we're making investments every month, every quarter. But with one investment, we bought a portfolio of 16 underlying funds from one seller that included household names like KKR, Bain, EQT, and so on. So very high quality funds. Each of those funds had somewhere between 10 and 20 assets. So it's instantly, with one acquisition, you have 16 managers and over 200 portfolio companies. So it gives you an example of how you can build that diversification. And by the way, in that case, we bought that portfolio at a 14% discount to NAV. So you're getting in at a great price too.
Jake, I'm asking every speaker this question. The Alternatives Symposium is closing with a workshop on exploring the institutional approach to alternatives. And advisors, many of them are looking at alternatives and wanting to try to replicate the allocations to alternatives that they see in super funds, for example, and not just the allocations, but also the way that institutions view and use alternatives. So what advice would you have or guidance for an advisor who's seeking to try to do that in the wealth space?
I think you have to look at some of the fund structures that are available and that have been designed for wealth. If you are a large super fund, then you're going to invest in institutional style products. These are 10-year life funds with drawdowns and distributions. They're clunky and complex to manage for an individual. What you now have in the private wealth space are perpetual vehicles where you can invest all of your money in one go. It's all paid in up front, and you can do that on a monthly basis. You can get liquidity on a monthly basis, and you can get instant diversification. So it's a much easier way to invest. But the underlying exposure, if you pick the right managers, is to some of the best quality assets in the market.
Jake Elmhirst from Coller Capital, always a pleasure. Thank you so much for your time today.
James, thank you very much indeed.